Hello, I am host of SmartFination, and I want you to picture a moment when something you've relied on for years suddenly falls silent. Not with noise, not with alerts or dramatic news, but with an eerie absence that feels off the instant you sense it. Early this Tuesday morning, January 27th, while most people were just starting their day, I observed the metals market doing something I've witnessed only a few times ever. There was no chaos, no wild swings, no rush of selling. There was quiet, an unnatural stillness rarely found in markets unless something deep has already broken. And then, without any buildup, the calm shattered. Not into a slow climb, but into a sharp split. The silver price didn't rise gradually the usual way. It didn't edge up, didn't climb step by step past barriers, didn't give traders time to react. It just snapped. As I record this, silver sits near $111 per ounce. What I witnessed hours earlier doesn't match any standard pattern I've studied during 12 years of tracking physical metals. I've tracked squeezes, I've tracked speculative surges, I've tracked liquidity jumps and algo-driven drops. This matched none of them. It felt like a mechanism losing alignment with the reality it was meant to reflect. Not gradually, not in stages, but nearly all at once. Huge chunks of silver stock at major U.S. dealers disappeared instantly. Out of stock, alerts replaced price displays that had existed seconds before. This wasn't a normal rush or gradual depletion. It was an abrupt vanishing of available supply. While that unfolded in the physical space, mainstream financial news delivered a completely different narrative. Switched to major outlets, and you heard steady confidence, positive forecasts, mild remarks about commodities stabilizing. No goodbye, no handoff notice, no phased departure, just gone. That matters because this surge is being labeled as speculation, retail excitement, momentum trading. That story falls apart the second you look at the physical side. It was a separation, a clear split between screen-based pricing and physical availability. This is what occurs when a quoted value keeps appearing digitally, yet the actual commodity can no longer be obtained in significant quantities. And the truly concerning element isn't the figure on your monitor. It's the discrete departures occurring behind closed doors at organizations that survive by mastering risk. Today's movement represents a point of irreversible change, not merely because silver hit a fresh headline level, but because Western price formation is being sidestepped by real-world demand originating elsewhere. When I began recording, I noticed a double-digit dollar gap between silver valued in New York versus silver valued in Shanghai. It is a process that systematically pulls physical bars from one region into another until one side exhausts its holdings. In this presentation on SmartFination, I will explain the workings of that mechanism, the calculations behind leftover stocks, and the consequences for a financial framework that is committed to delivering far more metal than it can actually provide. To grasp the situation, we must first correct a widespread misunderstanding. It's the cost of an agreement, a financial instrument, a commitment to supply silver later, provided many requirements are fulfilled. At that stage, you no longer have a single marketplace. You have two distinct worlds. In one location, it's priced low due to earlier long-term deals. In another location, purchasers pay several times more in immediate cash. Anyone who can reach both markets will purchase every unit from the low-cost shop until its shelves empty and resell where buyers pay more. The low price doesn't need bypass. Update quickly because it is bound by prior contracts signed under very different circumstances. That lag creates the vulnerability. It permits the entire setup to be emptied methodically while the reported price stays artificially suppressed. That describes precisely what is occurring between the futures platform in New York and the physical trade in Shanghai. The gap I noted earlier isn't merely broad. The futures venue cannot instantly reprice to reflect reality. While that resistance remains, the outflow persists. In Japan, one of the planet's biggest precious metals retailers completely halted silver sales. Not postponed, not rationed, fully stopped. This wasn't corporate portfolio adjustment. Simultaneously, the professional world sent its own warnings. Individuals in those roles don't depart lightly. When risk assessments show results that cannot be handled through announcements or margin adjustments. When those nearest the engine begin stepping out, it deserves notice. I know the counter-argument already forming. We've witnessed this pattern previously. Critics say silver surges, then collapses. During every turmoil, metals get liquidated to offset losses elsewhere. That occurred in 2008. It occurred in 2020. They're accurate about history, but mistaken about the current setting. Storage was plentiful. The paper system, imperfect as it was, still rested on a physical foundation. Today, that foundation has vanished. Stock levels at Eastern exchanges have plummeted over the last couple of years. What once acted as a cushion is now dangerously narrow. You cannot liquidate what isn't present. When delivery is requested, someone must unlock storage and supply genuine metal. If it isn't available, the agreement loses substance. That exposes the weakness in assuming paper markets can restrain prices indefinitely. They can, until widespread delivery is enforced. And that enforcement is no longer hypothetical. It's active now, fueled by nations and purchasers no longer content with cash resolutions or assurances. They demand metal. That one choice alters the entire landscape. We stand only at the start of this development. The calculations involving stocks, delivery pressures, and arbitrage movements are what transform worry into certainty. And that's our next focus, because once those figures are presented clearly, it grows extremely hard to accept that this arrangement can keep operating as it always has. This is where most lose focus, because they're conditioned to track price rather than framework. Price reacts last, framework shifts first. Earlier today, while silver traded near $111 an ounce in New York, gold held steady too, but neither figure ranked as the most critical information I monitored. The key number was the amount paid elsewhere for instant physical possession. In Shanghai, silver commanded a substantially higher value. Not minor differences, not token extras, but a gap wide enough to guarantee gains for anyone able to shift metal between regions. That gap shouldn't persist long in a balanced system. Arbitrage exists to close it. The issue arises when arbitrage requires sufficient supply to satisfy both markets. When one market faces contractual limits and the other pays any price necessary, the outflow doesn't pause, it speeds up. To see why this is significant, consider how futures platforms truly operate. Futures were never intended for mass physical delivery. The registered stock category exists to accommodate the minority who insist on delivery. It was never planned to handle prolonged, organized demand. Now consider inventory, because this is where concepts meet facts. The quantity of silver marked as registered and ready for delivery has shrunk steadily for years. Some shifts to eligible status, some exits the system completely, but the direction remains clear. What once provided ample room has turned into a narrow edge, and edges are where breakdowns occur. Allow me to outline two possibilities, because this concerns mathematics, not emotion. In a cautious case, imagine only a moderate share of registered stock departs weekly via arbitrage and requests. Not extreme levels, not rapid escalation, just consistent removal. At that rate, the registered portion hits zero within weeks, not months. Zero doesn't imply no silver remains globally. It means no silver stands ready to fulfill delivery rules at that venue. At that stage, the platform faces limited paths, alter regulations, limit withdrawals, mandate cash resolution, or offer stronger incentives to attract metal back. None rebuild trust. They merely extend the timeline, and time becomes the one resource the system lacks while the outflow continues. Now examine the high-pressure case, because this is where fragility appears. Tens of millions of ounces already stand for delivery in the present period. That obligation exists, is binding, and has deadlines. Current stock can technically satisfy it, but only if nothing else disrupts. No extra requests, no ongoing arbitrage losses, no sudden retail wave, no transport issues. That's an unrealistic expectation. Markets never function in a vacuum. And while vaults empty, refining operations already operate at maximum. Facilities producing approved bars run near capacity. Processing times, once counted in weeks, now stretch into months. That delay is critical because even rising prices cannot summon supply instantly. You cannot fabricate silver. You cannot accelerate natural deposits. The physical chain possesses built-in delay. And delay proves fatal when sudden adaptability is required. This explains why past comparisons collapse. In 2008, silver dropped because liquidity was needed and metal existed in quantity. The framework flexed without shattering. Today, the framework stays stiff precisely where flexibility is essential and loose where rigidity is vital. Paper agreements can grow without bound, but physical volume cannot. Yes, they can. Until delivery is actually called. The boundary cannot be crossed without repercussions. Paper commitments function only while confidence lasts. Confidence vanishes the moment delivery falters or regulations shift suddenly. Once that occurs, every linked agreement faces scrutiny. This is why professional actions matter. When high-level individuals quietly step away during tense periods, it rarely concerns one position. It concerns broad exposure. Risk systems ignore stories. They track connections, extreme outcomes, and breaking points. When those systems turn critical, people act. Meanwhile, everyday behavior evolves. The events in Japan aren't unique. When sellers halt transactions completely, it isn't because they prefer disappointing buyers. It's because they cannot acquire metal at levels that justify the exposure. When queues form and waits extend hours, it signals mindset change. People stop debating whether silver costs too much or too little. They question whether it will exist to purchase. Margin increases come first. Sharply raising position costs pushes leveraged participants out. That can trigger abrupt price falls, even in fundamentally constrained settings. We observed this tactic during the climb toward $50 in 2011. Margin rules tightened repeatedly until the advance broke. The distinction today is that physical supply faced no similar pressure then. No large-scale eastward drain emptied storage. Today, a margin-forced pullback may depress screen values but fails to halt physical appetite. In fact, It can widen the arbitrage opportunity. Another measure involves trading curbs, forced closures, temporary pauses, or emergency steps meant to reduce pace. These aren't stability markers, they're strain indicators. When a platform restricts access, it implicitly concedes it cannot handle normal flows. I track two key signs closely. First, the Asian premium. If that difference grows larger, it confirms physical appetite overpowers paper availability. Second, registered stock falling beneath vital levels. At that stage, one major delivery call could deplete remaining supply. That's when credibility vanishes. Here, the discussion moves from valuation to ownership. An assignment differs from receipt. When frameworks face stress, that distinction becomes crucial. Systems can postpone, curb, or redefine conditions. Physical control eliminates that ambiguity. I'm not outlining a certain result. I'm outlining a probability range that has tilted sharply. When several unrelated indicators align, disregarding them becomes deliberate rather than accidental. We observe a framework constructed on premises colliding with a reality rejecting those premises. The strain isn't whether silver rises or falls next session. It's whether the pricing structure can persist without rule alterations. And once rules change, the market you believed you knew ceases to exist in its prior form. That awareness, far more than any chart, deserves your focus as this unfolds. This marks the convergence of everything discussed, because markets rarely fracture alone. They fracture along pre-existing weaknesses, and silver lies at the crossing of several. One frequently ignored aspect is infrastructure. When envisioning delivery breakdown, people imagine bear vaults. Reality proves far more intricate. Even if silver exists globally, it must still undergo refining, validation, shipping, coverage, and exchange acceptance. Each phase presents a possible choke point. Right now, every phase endures pressure. Refining infrastructure especially remains vulnerable. Only a handful of facilities create bars meeting exchange standards, and those facilities cannot ramp output on command. Recent information shows processing delays have lengthened considerably. What once took weeks now requires months. That lag matters because it prevents supply from reacting swiftly to price cues. If registered stock shrinks faster than new refined supply arrives, the shortfall grows. This triggers a chain reaction. As immediate availability tightens, premiums for prompt possession climb. Climbing premiums draw metal from long-held storage, but only if holders choose to release it. Many refuse. A large share of metal in approved vaults belongs to long-term owners who placed it there years earlier. They aren't short-term traders. They don't react to 10% swings. They observe the same structural warnings and decide selling now risks regret. When owners decline converting eligible to registered status, inventory figures mislead. On records, supply appears adequate. In practice, it remains out of reach. That's how liquidity seems intact until the precise moment it vanishes. The appearance holds until failure strikes. If a platform cannot fulfill delivery duties, the fallout reaches well beyond one asset. Silver threads throughout finance. It supports derivatives, packaged products, and collateral networks most never examine. Commodity agreements frequently serve as security in short-duration funding. If trust in those agreements weakens, credit freezes. We witnessed a similar pattern during the housing collapse when once secure assets suddenly became unacceptable collateral. The outcome was a near-total halt in funding that almost destroyed the system. A delivery shortfall doesn't need scale to create massive effects. It only needs to plant uncertainty. And once participants doubt whether contracts represent reality, the entire valuation process faces doubt. And when valuation fails, markets cease being markets. They become discussions, exceptions, and crisis responses. Another actor rarely highlighted directly is government entities. Central banks have openly increased gold reserves for years, yet silver buildup has remained discreet. Trade statistics indicate steady purchases via state-connected channels, especially across Asia. Unlike gold, silver requires no public reporting. It can accumulate through industrial routes, investment structures, and strategic holdings without fanfare. If a national entity chooses to apply force to silver markets, it needs no announcement. Trust in Western mechanisms weakens. Its alignment of interests. Nations aiming to lessen dependence on dollar systems possess strong motives to challenge those systems. Commodity markets offer natural stress points because they bridge finance and tangible reality. Prices can be influenced, but metal cannot be conjured from nothing. Another crucial change involves sentiment. For years, precious metals holders faced ridicule as doomsayers. Those who dismissed metals begin watching. Those who ridiculed begin inquiring. That attention surge can accelerate demand far beyond supply's ability to match. In a limited physical environment, growing retail interest doesn't produce balance. At that stage, listed prices lose meaning. What matters is whether the asset can be acquired at all. This leads to why I personally maintain silver holdings, because the reasoning is frequently misread. I don't maintain it expecting wealth. I maintain it because it operates beyond financial infrastructure. Most assets, regardless of spread, rely on systems. Exchanges must function. Banks must remain solvent. Transfer networks must operate. Ownership records must stand. Silver requires none of those to retain worth. That doesn't make it riskless. It yields nothing. It fluctuates sharply. It may lag for extended stretches. Yet it shields against a particular risk category few alternatives cover. You don't insure property expecting certain destruction. You insure because the cost of being mistaken proves catastrophic. The price of holding silver, if incorrect, is foregone returns. The price of not holding, if correct, is unprotected exposure to breakdown. I cannot offset elsewhere. That imbalance matters most. Viewing the full landscape, every indicator reviewed points the same direction. Arbitrage differences endure. Stocks diminish. Refining limits tighten. Professional departures occur silently. Retail appetite rises visibly. Eastern markets claim physical pricing authority. Individually, none prove conclusive. Collectively, they create a pattern difficult to ignore. For years, skeptics correctly noted paper market influence. They also correctly observed those markets persisted longer than anticipated. What they misjudged was the instant when physical appetite would demand resolution. Control functions until delivery arrives. At that point, rules either adapt or structures collapse. This isn't a repeat of earlier squeezes resolved through margin increases and fatigue. This represents the tangible world imposing limits on financial abstraction. It marks the collision of agreements with actual stock, of trust with practical delivery. I cannot predict the precise timing this reaches conclusion. I cannot forecast when delivery shortfall becomes formal or when pricing authority permanently relocates. What I do recognize is that the warnings have ceased being faint. Those nearest the exposure quietly reposition. The processes have begun. By the time wider audiences comprehend the development, critical actions will have occurred. Metal will have relocated. Regulations will have shifted. Prices will mirror realities that appear unthinkable today. Structural fractures unfold this way, not through one explosive occurrence, but through successive choices that, looking back, all indicated the same outcome. You need not act. You need not concur. But you should comprehend the process. Because when quiet emerges in a market presumed liquid, it almost never happens by chance. And when that quiet ends, it usually signals that something foundational has already failed.